B-Day Personal Finance video. By the end of this session, all students should be able to recall and define a range of personal finance terms. Most students should be able to explain the advantages and disadvantages of different financial products and services. And some students will be able to critically assess the different financial products and services that are on offer to the consumer. This video forms part of the resources that are being put together by BeeBusinessBee for the Personal Finance B-Day activity. Ensure that you download the resources and you have them to hand, which will help to complement this video. Let's meet Mike. Now Mike is confused. What should Mike do with all that money that's in his piggy bank at home? Well, Mike is more concerned because money becomes worth less every year he saves it in his piggy bank, and that's because of this word called inflation. Inflation, simply explained, means that money becomes worth less every single year. Let's look at the example that Mike has got. He used to be able to buy the sweets that you can see on the screen for 2p last year. However, this year it will cost him 5p. So this means that his £1 will now buy him less sweets than it used to buy him. So as a result, inflation has taken hold, and as you can see, it's making his money worth less, and it's also seeing prices increase. And that's one key term that starts to worry Mike. So what can Mike actually do about inflation? Well, one option is to place his money in the bank, but that will mean he needs to open a bank account. And why would placing his money in a bank help him? Because most bank accounts start to pay interest. Now, when he goes to the bank, Mike is going to find that the banks offer different types of accounts. Now, Mike needs to choose the best account that's going to suit his needs personally. Now, one type of account that might get offered by the bank is something called a current account. Now, this type of account is typically free to open. Now, this type of bank account will allow Mike instant access to his day-to-day transactions for his money. This means that he can carry out all those financial activities you'd expect to take place. So his wages could be paid in, for example, and he can pay bills out of that account. Now, this account does not typically pay any interest on the money that Mike keeps in it. However, Mike will get access to a debit card, he'll get a checkbook, and he could even set up something called a direct debit. Now that leads us to an important question. What do we mean by a debit card? Well, the debit card is the plastic card that you tend to get from your bank, and you can put it into something called a cash machine or an ATM, an automated teller machine. Now, it's a form of electronic payment in which the funds come directly from the bank account. So what this means is that Mike can only spend the money which he has in his bank account. He can't spend more money than what he's got in his account. To do just that, Mike needs another type of card, and he needs to be 18 years old to have this type of card. This is something called a credit card. Now, that is because the term credit effectively means borrowing money. And it's a form of electronic payment in which the funds come from the bank, not Mike's bank account, but the bank's bank account. And Mike will have to pay back the bank, usually monthly, with interest for the facility of using the credit card. He'll get charged something called an APR, that stands for annual percentage rate. And typically that annual percentage rate will mean that what he spends on that card will actually cost him more overall. Mike, however, could opt to repay the card in full every single month. Why would he do that and not use a debit card? Because there are some advantages to a credit card. For example, if Mike was to buy online and then the company went bankrupt and no longer existed, then Mike could actually get his money back from the credit card company. The credit card also could provide insurance and protection. So, for example, if Mike was to have purchased a brand new mobile phone on his credit card, he was to walk out of the shop and somebody to rob him of that mobile phone, then as long as he hasn't actually paid the credit card company for it, it still belongs to the credit card company. So technically, it's still insured. There are many, many rules and many advantages to credit card, but remember, also many disadvantages to Mike of that credit card because he's borrowed money that he has to pay back with interest because of that APR charge. Now, it was mentioned about a direct debit. Now, direct debit is a form of electronic payment which Mike can set up with his bank to pay somebody else on an agreed date. Now, why might he do that? Well, typically to pay some bill. So maybe when he wants to pay his electric or his gas bill, he might set up a direct debit, and on the same day each month a different amount will go out, and that's the key advantage of a direct debit. It can be a varying amount, but it'll happen on the same day. So Mike will always know what day he's going to pay his electric or his gas bill. Mike might also get offered one of these when he opens his current account, something called an overdraft. Now, what is an overdraft? It's a short-term loan that Mike gets access to, and that will allow him to spend more money than what he currently actually has in his bank account. So this means that actually he can go into debt. If you look at the example that I've got there on the right-hand side of your screen, when Mike's bank account reaches zero, if he was given an overdraft limit of £500, that means he can actually borrow £500 from the bank and they won't say anything about it, just let him lend that money straight away. That's usually because he's agreed it in advance, so he's actually had an agreement with the bank that he can go overdrawn by that amount of money. Of course, why would the bank do exactly that? They're going to charge him an APR, an annual percentage rate, and that'll be quite high if he was not to repay the overdraft because they're lending him the money in the short term. The bank is only giving that money because they know that they can get more profit from Mike borrowing that money. So Mike needs to be careful and he needs to ensure that it's only a short term. By short term we mean less than 30 days in an ideal world. Otherwise, this becomes an expensive loan that Mike might take out. And that's why it ties in with another type of loan that Mike get offered. So Mike may get offered something called a bank loan. Now, typically we talk about these being medium to long-term sources of finance. And this may allow Mike, for example, to purchase a new car, or maybe he wants to see an extension in his house. And Mike will then agree a set amount of money that the bank will lend him, again with an APR charge. And as a result, he'll have to make a repayment every single month, but it tends to be a fixed monthly payment over a set number of times. So, for example, 36 months or 56 months. It's a set agreement and he will pay back maybe £29 a month or more realistically £500 a month for a bank loan. Of course, again, the bank charges an APR. Typically though, the APR is lower on a bank loan than it would be on an overdraft, but remember, you're paying it back over a longer period of time. Now, the last type of loan that Mike might want to take out could be something called a mortgage. Now, a mortgage is always a long-term loan and it's tended to be used to purchase a building. In Mike's case, he would want to go and buy a house. So if he wants to buy a house, he needs to take out a mortgage. Now, Mike would repay that mortgage over a long period of time. And again, it comes with interest charges. Now, the APR on a mortgage tends to be a lot lower, more like 3%. However, bear in mind that Mike will be paying back this mortgage for maybe 25 years, 35 years, 45 years. So even though it's a small APR, it's a small APR on a large sum of money that Mike's borrowed, which he's going to pay back over a long period of time. Now, another type of account that Mike might be offered from the bank could be something called a savings account. Now, this type of bank account is an account that typically will pay a higher rate of interest, so Mike will get more money for saving his money, a reward for saving his money with the bank. And it allows money to be saved over a period of time. Mike could find if he opens one of these accounts that actually he can't instantly access his money like a current account, and he can't carry out all those day-to-day transactions that he has because the bank is expecting him to save his money. Because remember, when Mike saves his money in the bank will then use Mike's money to lend it out to another customer to make more money from it. So even though Mike has been rewarded for saving, the bank's actually making a profit by lending Mike's money out to somebody else and making a profit on that. Another type of account that might be offered, and the final type of account we're going to look at, is something called a premium account. Now, this type of bank account tends to be like a current account, but it offers some added extras. Of course, there's got to be a catch to that. They will give him a monthly fee, so Mike might have to pay £10 a month for this bank account. Now, Mike might find if he opens one of these premium accounts with his bank, he could get mobile phone insurance and holiday insurance, which actually might be cheaper than getting it elsewhere because it's all being bundled into his bank account agreement. However, Mike also needs to consider that maybe he's paying for something there that he's already paying for, or it's going to cost him more than what he could get elsewhere. One of the main benefits of a premium account tends to be the fact that you've got a current account, you'll get a higher rate of interest paid on your balance. What that means is that maybe your current account becomes like a savings account for the money you keep in it. Of course, maybe Mike should really open up a savings account because then he'd be less likely to use that money and more likely to save it in his bank. Now, of course, everything we talked about so far is all down to this thing called an interest rate. Now, where does this tie in to what we've looked at so far? Well, that's because the interest rate is really important because it helps prevent something called inflation, which we've looked at already. Now, if inflation, for example, was at 2%, but the interest rate was at 3%, what the banks are paying for Mike to save his money, that means that Mike is going to have more money in the longer term and inflation won't devalue the money that he's saving. He's actually slightly better off. But let's assume that actually Mike finds that even though inflation is 2%, his bank is only offering 1% for his savings. That means that actually Mike is losing money, even though he's saving his money in the bank. And that's why it's really important when you're choosing a bank account, and especially a savings account, to choose the one with the highest rate of interest. And not just choose the highest rate of interest on its own, but look at what the current rate of inflation actually is. You want a bank account that pays more than what the current percentage rate of inflation is. So where does that interest rate come from? Well, interest rates tend to come from what's set at the Bank of England. They set something called the base rate of interest. Now, the Bank of England is a big, large bank in London, and they are the central bank for the UK. They control the flow of money. What that actually means is they print the money that Mike gets to spend every single day. Now, the bank will adjust the interest rate based on what's happening with spending and consumer confidence. If people are happy and spending too much money, then that will see that prices are going to increase, which actually creates inflation. Now, to slow that down, the Bank of England will increase the interest rate. Because if they increase the interest rate, people like Mike is more likely to put his money into the bank and save it. Whereas, on the opposite effect, if people like Mike aren't spending money, then to help him and encourage him to spend, they will lower the interest rate, because then Mike doesn't get rewarded as much for saving in the banks, and as a result of that, he's more likely to go out and spend. But Mike can't do his banking with the Bank of England. The Bank of England is a central bank that deals with the other banks, the ones that Mike will go and see in the high street. Okay, hopefully now you, like Mike, understand a little bit more about the key terms in personal finance and how some of those all fit together. However, Mike is still looking forward to receiving some more help and guidance from you. Make sure you complete the next activity now. Thanks for checking out the BeeBusinessBee YouTube channel. Don't forget to click the subscribe button down below to subscribe to our YouTube channel. Don't forget to follow me on Twitter. It's at BeeBusinessBee. Also, give the Facebook page a like. It's facebook.com/BeeBusinessBee. And lastly, don't forget to check out the online hive of activities found on BeeBusinessBee.co.uk, full of quizzes, activities and resources. And remember, until next time, keep buzzing.